Good morning. Anton Stetner here. And today I'm going to go through a bunch of data with you. I'm going to review the market statistics here in the Seattle Metro and go through what's been happening in the market. Why are home prices going up? What are we seeing? What should you be looking for this year as an agent, as a buyer, as an investor? And what's the data telling us about where we're at, where we're going? And why is the market already kind of so hot? Okay, so I am going to hit this little magic share screen, a window, share. Okay, so we got that up, and let's go over here. So who am I? I've been selling real estate since 2003. Me and my team, we've sold thousands of homes here locally. I own two brokerages. We do new construction. We do land development. We own rentals. And I love numbers and data. And what I want to go through with you guys today is like, what's specifically happening? So something to pay attention to is one, know that we are in a transaction-based recession. We are not in a price recession, and that the rates are showing up and the rates are mattering. The rates are what is making the biggest difference on whether we're having a ton of transactions or not a ton of transactions. And as all of you know who have really been paying attention to rates, as rates have been ticking up here locally, that's been putting pressure on these buyers and pinching some of them out. As it basically crested over 7, we hit a 52-week high in interest rates. So rates definitely matter to us right now. I think you got to pay attention to what's always happening with the 10-year treasury. Whatever's happening with the 10-year treasury is going to show you the trajectory of where rates are going. Also understand, once the Fed has started cutting rates, once they've started cutting, generally speaking, all they do is then cut over the next 1.5 years. Lastly, in our area, understand building permits and land development applications are down. And especially when you look at the big multifamily ones, the big multifamily, they make phenomenal sense when rates are 3%, when rates are 4%. But as rates have ticked up, that multifamily pipeline has started to pinch, and realize multifamily takes 2 years, 3 years to get all the way to the market. So they're finishing up that new construction of multifamily right now, but that was started all the way back in 2021, 2022. So expect there to be a drop probably late 25, definitely in 26, in that available new multifamily coming, which may create opportunity for you, opportunity for me. As I go through this, realize this is a live. So I got the chat sitting right in front of me right here. And if you have questions about the market specifically, or comments or things we want to address, or there's a spot that you want to look at, let me know and we will totally go through that together. Nationally, this is what I want you to be watching: unemployment. So inflation has been totally beating up on us as the consumer. The consumer is feeling pinched because it basically costs more for them to live. And especially when they go to the grocery store, that dollar just isn't stretching as far. But unemployment is more important to the real estate market than inflation, because inflation is now low enough to where you're hearing the Federal Reserve only talk about employment. They're not talking about inflation anymore. Next, I want you to actually listen to what the Fed is saying. So this week, I think it was Goolsbee, one of the Fed presidents came out and they used their voice. As they use their voice, they're controlling the market. That's one of the things that helped to push the 10-year treasury down a little bit lower this week. Also watch GDP, also watch geo-local political events and your kind of geopolitical events that are happening with other nations and conflicts. And then how is that going to affect us? Okay, locally, this is important. So I'm going to hide myself for a second. You totally need to watch unemployment. And we need to watch the number of new listings coming on the market. Where is inventory at? What's happening with quick sales? And the reason I bring up quick sales specifically is if all of the inventory is leaving in the market in the first 2 weeks, that market is really hot. There's a lot of things going on with it. Let's look at supply and let's look at percent of original list price. Percent of original list price can be thought of very simply as if the property was on the market for 100,000 and the percent of original list price is 98%, it means the average buyer got 2% off of that list price, or approximately $2,000. As soon as we dig into the data, you're going to see this in the seasonality. And I tease every year, but I say that this time of the year is deal season. Why is it deal season? It's deal season because it shows up in the data. You can see it. So as a hardcore investor myself, I'm always trying to buy a lot in November, December, January, and February, because that's the coldest time of the year. It's raining outside. I mean, it's kind of sunny. Well, it's not sunny. It's not raining here in Seattle right now. It was raining yesterday, but as this weather continues, what happens is that means there's less buyers, there's less activity, but there's also less listings. And of course, we need to watch the sales price. So before we dig into the data, I just want to go over this real quick. Average versus median. The average price is add them all together, divide by the total. The median is the middle of whatever is happening inside of that market. The median will not move as much as the average. So we're going to look a little bit more at the median than the average. King County. So I went and exported the data from the MLS of the median price on a monthly basis. I dropped it into ChatGPT. And PS, you could just do this in Excel, but it's really easy in ChatGPT. And I said, what has happened to prices in King County over the last 10 years? The median price has increased 8.3%. That is so far above average. So realize here in the Seattle Metro, we have above average appreciation relative to the rest of the nation. 8% is huge over the last decade. And what a lot of people say, well, this can't continue. In the data, we're going to look at it here in just a second. You can see it did continue this year, even in the face of geopolitical events, even in the face of inflation, even in the face of 7% interest rates. This high level of appreciation continued. King County 10 years ago was only 397,000. We finished at about 855. This is the chart from ChatGPT. I told him to put a trend line on it. The little dot above is 5% above trend. The dot below is 5% below trend. As you can see, there's the seasonality that happens throughout the year. And then, of course, we're projecting out where the trend is going. So this right here, this next piece of data that I'm going to show you, this is the 12-month average. In other words, this data is smoothed out even more. And when we dig into the actual data in the MLS, I like to look at it on a monthly basis because it shows you a little bit more of the nuances in each month, and you can actually see the movement. However, when we're looking at markets over a long period of time, this is another way to look at it, is to smooth the data out and look at it over a 12-month period. So throwing this back up. New listings, 2024 to 2023 was up 14.7%. So when we talk about King County, think about King County is the center of our real estate universe. And specifically, whatever happens in King County, the rest of the counties basically fall in line with that, with Seattle and Bellevue definitely being kind of the epicenters of our real estate universe. Pending sales up 9%. One thing to add in about pending sales is I do believe that rates have already most likely peaked this year. And that rates will trend down from here. So if last year pendings were up 9 and closed sales were up 7.8, I would expect closed sales to be up even more in 2025. So for those of you that are real estate brokers and paying attention to this, that means you're going to get a natural raise by just a few more percent of transactions showing up in the market. I believe you could see 10 to 15% more transactions throughout the whole metro in 2025. So if you're a real estate broker and you sold 20 homes last year, that means you should sell an extra 3 to 4 homes this year by simply staying in touch with everyone. Understand, as an investor, what this means is there's going to be more demand. Okay, let's go back to this. Days on market was down 8%. And I'm looking at this right here, this data right here. The median sales price up 8.5 and average up 9.6. So the median ended 2024 at 955 and the average was 1.2. When I started in 2003, if you would have told me the average price in King County would end at $1.2 million, I would tell you, you are crazy, you are insane. I did not expect this level of appreciation over the last decade. I started really following these numbers during the great financial crisis on a certain level out of necessity. I had to really understand the market. And Jerry, I absolutely love what I do. Love real estate investing, but I love sharing this data with our consumers, with our buyers, with our sellers, our builders, because when you understand where the market is going, you can make adjustments and you can learn from it and you can get the best deals. You can make money. You can price your own properties correctly. You can price properties for sellers correctly. I think this is the key. The key to being a real estate professional is having a deep understanding of these metrics. Okay, let's go over to Snohomish County. Snohomish County, 9.65% in median price over the last 10 years. As a reminder, let's go back to King. King was only 8%. So why was Snohomish County 9.65? I believe Snohomish County outpaced King County because of affordability. The second thing that you saw happen was that's also where a lot of the new construction was able to happen. A lot of King County is already built out, so more new construction happened outside of King County than happened inside of King County. Last but not least, COVID, remote work, that helped push people more into the outlying areas, with Snohomish County being the second largest county in our metro. So just my thoughts. By the way, if you have a different reason or you think something else in relation to Snohomish County, drop that in the chat. Let me know. For those of you that are just joining, you're always welcome to ask your questions, add your comments anytime you see something that we're talking about. I'm happy to dig into it more. Snohomish County, 304,000, ended at 740, the same projections. This big blip that you see right here, this is going up into 2022. Then the Federal Reserve says Mayday. They raise rates, and you can see prices basically capitulated due to those high rates. Then they started really trending right back up again. Why did they start trending right back up again? The reason prices started trending back up again and we didn't go through the massive foreclosure crisis and the market didn't fall apart is supply. There is a massive lack of supply because in 2008, 9, 10, 11, and 12 here in the Seattle Metro, we did not build as many homes as we did before. So I was doing a ton of new construction in the early 2000s. Most of my business was builders and developers and investors as we went into the great financial crisis. And when the GFC happened, the freaking lights went off and my business literally dropped by 70%. As my business dropped, it's because there was so much new construction out there. Those banks then foreclosed on all those builders, all those developers. We were overbuilt because you could overfund things. Pre-Great Financial Crisis, you could finance up to 100% loan to value. Today, you can only finance 75% loan to cost. So most projects have between 25 to 35% more cash in them today, which makes them more stable. Also, our buyers today are some of the most well-qualified buyers we've had in forever. So our buyers qualify, they have equity, they have jobs. And then people go, well, what about credit card debt? Even though credit card debt and student loan debt have risen dramatically, total household debt, or their debt relative to the amount of income they have, is still lower than it was previously. So don't let the media lie to you when they say credit card debt is going to cause this one to happen. They also lie to you and they say foreclosures are rising dramatically. They're up 300%. When you go from like 0.2 to 0.4 or 0.5, yes, it can shoot up 200-300%, but we're still so far below the average of where we were before. Okay, looking at Snohomish County, new listings up 13%, pending sales 5.8, closed sales 6.9 year to date. We ended up 6.8%. at 780,000 in the median price, and the average price ended at 871. I was asked the question a little bit ago, how long until the average price crests $1 million in Snohomish County? What's crazy is at this current run rate, sometime within the next 2 to 3 years, we should, and I don't even like saying this, but the average price in Snohomish County should crest $1 million. Blows my mind. Why do we have this massive lack of affordability? And this affordability is hurting the local economy and the middle class in rents, in preventing people from getting homes, especially on that first-time home buyer side. It's a lack of supply. Currently, the Puget Sound Regional Council voted not to expand the buildable land inventory in these metros. So I'm talking Thurston County to Whatcom County, except for in a couple little areas. So there's not a bunch more land coming. They simply increased density, which is going to continue to force and drive up prices. P.S. I don't like that. I'm just explaining the data to you. Okay, now I want to dig into some of the actual data. So this is the entire MLS. The entire MLS represents about 80% of Washington State, but I want to break this out. I want to go to 5 years, and I'm going to hide myself real quick to make this easier to see. This is that consistent seasonality we're talking about. See how in 2021 it peaked at I believe that's the median. Let me figure out. Yes, that's the median. 2021, July, the median price for the NWMLS peaked at 560,000, but then see how the price goes down? Peaked in 2022, dropped, peaked right there in June, peaked right there in May. And what you can see is this is the seasonality for the entire MLS. When I'm talking to you about how the winter is deal season, this is the number that shows this metric. If you want to know how bidding wars are starting to happen, look at this metric. You can go in if you're a licensed broker, and if you're not, you can contact us. But we can go into the MLS and we can go down to a zip code or a city, or we can draw a box and we can start looking at these numbers specifically. And what you see is this consistent seasonality, peaking in March, down in the winter, peaking in June, down. So in June, the entire MLS of 2023 was at 99.1%. It means the average buyer got about 1% off the list price. Then it got down to 95.9. That means the average buyer got over 4% off. And then this last winter looks like we basically peaked in April, May, and then the average buyer got approximately 4% off. Let's look at King County specifically. Okay, King County. King County, the massive bidding wars, in 2022, the bidding wars of 2021. Look at that, 107, peaked out at 111, insane. But then it starts to normalize as the rates came up. So this is the bidding wars starting. And this right here is the same thing. So let's just look at last year. We started in December at a low of 96.4 in King County, went to 97, and then we peaked in April at 102, and we finished the year at 97.6. As the cherry blossoms come out, this is your definition of the spring market. Whenever you see the cherry blossoms, know the spring market in our area has started, and expect the list to sales price ratio to continue up over the next few months, then peaking sometime in April, May, or June, depending on the year. That means if you want a deal, you have to be hunting before that, aka right now. Or you've got to be hunting after the summer because prices generally cool down towards the end of the year. Now let's look at sales price. I'm going to drop this to 3 years. I think I've made my point on the data. We ended last year in December of 2023 at 775,000. January was 760. We peaked at 880 and then dropped back down to 790 on the median. Let's look at the average real quick. The average, January of last year, 984. January was 957. We peaked at 1.14, back down to 1. That's that seasonality. Number of new listings. Number of new listings slightly up over this time last year, but let's go back and look at this. How do I make that go away? 5 years. Okay. You can see that inventory over the last 2 years, there has been less coming on the market. That is that lock-in effect. It's because people have good interest rates and they don't want to trade their 3%, 4% interest rate for a 6 or even a 7. Number of homes for sale. Number of homes for sale up. But still, if we go out 10 years, still much lower in King County than it was previously. So the idea that you're returning to a normal market, you are returning to the level of pre-COVID of 2019. So if that's our definition of a normal market, I would say the Seattle Metro is returning to a normal market. We're returning to similar rates of appreciation. Once again, depending on where you're looking at it, in the kind of 6 to 9% range. What we're not returning to is we're not returning to the same transaction level that we had before. So I'm going to show you closed sales next. Closed sales. I don't know. Okay, I got to get rid of this thing. It's killing me. King County. There we go. So let's look at this over 10 years. See how 2023 peaked at about 2,400 and then 2024 peaked at about 2,600? That peak is below what we were selling in 2014. Let's go to max. That peak puts you in line with sales approximately 2011. So when I say we are in a transaction recession and not a price recession, that's the data we're talking about. We're selling the same amount of homes in King County right now that we did in 2011, 2012. Holy cow. So that's why some real estate agents, just to be blunt, they're not selling a lot. That's why some loan officers had to get out of the business, because the whole market contracted by about 40% in total transactions. So the people who are doing a lot of business right now are basically raising their hand and saying, we are the professionals. We know what's going on. They're the ones doing business. The people who got into the business when it was easy or didn't learn a ton of skills are the ones who aren't currently doing all the business. Okay, let's drop this back down to 3 years just because it's easier to look at. Days on market, let's look at the average. Days on market trending up for the winter. But as you can see, in the spring of last year, it got as low as 17 days. Now, when we're talking 17 days and the average days on market, that means that the average property was selling in just over 2 weeks. That's really fast. Anything below 30 days, the market is really starting to cook. Let's look at supply. Months of supply of pending, 1.6 months. We did peak out in September at 2.9. Realize below 6 months is still a seller's market. We have not seen a buyer's market. I'm going to max this out for you. Look at this. You haven't seen a buyer's market since way back here in approximately 2011. And once again, see this giant peak of inventory? That's why we stopped building so many homes. The problem is we got so far behind on new construction, and permitting timelines went up, development timelines went up, cost to construct went up, codes went up. So now we're behind, and the process is harder, longer, and takes more money, which is just going to continue to lift that pricing. Once again, for any of you that are just joining us, if you want me to go over a city or a zip code or something like that, I'm happy to do that. I'm just going through King County right now. I'm going to do a little bit of Snohomish County, but happy to jump into any of the other ones. We already talked about the percent of original list price. When we look at this, you see it peak, in kind of that spring. And then, of course, deal season being the latter part of the year and the beginning of the year. I also like to look at this one, shows depending. The ways to think about shows depending is that right now in King County, it takes 17 showings to sell your home and get a contract you agree to. Well, but the average showings per listing is only 4.8. So one of the things to understand that this is a signal if you're a seller and you're on the market. This is a signal if you're a listing broker, that if you got 5 showings and no one had the guts to tell you in the feedback, because sometimes agents are just too nice. But if you only got 5 showings and you had been on the market a few weeks and the condition was good and the marketing was good and it was properly positioned and properly presented, then the next thing you've got to deal with is price, because it just showed you have to get, I want to get the exact number, 17. You have to get 17 showings to sell. Okay, let's look at Snohomish County together. Snohomish County, let's go to sales price. Let's look at the median. This dialog box does not want to go away from me right now. Leave me alone, dialog box. Okay, perfect. The median price in January of 2021 was just $546. And we ended in December at $734. We are still not above peak 2022 pricing, versus when you look at King County is above peak 2022 pricing. See that? King is 876. And then right there, we got to 880. So we did beat that on King. We have not beat that yet on Snohomish or in the other outlying counties, Pierce County, Skagit, Island. Average price, 2021, 573. We just ended at 808. What's interesting about Snohomish County is Snohomish County did not see the same level of rolling off of pricing. It didn't see the same down. I think that's also, again, due to the affordability. That affordability factor is going to it's going to hold prices higher even when the market cools down. Number of new listings, okay, right now up 18%, but still, as you can see, we're below the peak. Homes for sale up 22.9. Pending sales, really about the same as the previous year. Let's go to the closed sale story. So closed sale is up in December versus the previous December. But when we go out and look, you can see closed sales are, below this 1,000 units. And to get back there, we've got to go back to, 2011, and then it crests it in 2012. So when I say that we're in a transaction-based recession in real estate, this is what we're talking about. It's that we're selling the same level of homes that we did in the great financial crisis. And this could also be thought of as base level demand. What I mean by that is the United States as a whole, it's going to sell around 4 million units due to the forced things, the job relocation, death, divorce, diapers, diamonds for getting married, things like that, those life events. That's what you're seeing right now too, is life events are really one of the big drivers. And this is a base level of transactions here in the Seattle Metro. If anyone has any specific questions, once again, drop it in the chat. Happy to go through it. You can see though that Snohomish County mirrors exactly what we saw in King County, just with some different numbers. Days on market. Oh, let's get out of that max. Back to the 3. So days on market, we finished the year at about 35. May of 2024, it was only 16. So once again, if you hit that 2 weeks on market, that's going to be a hot, hot, hot market. Months of supply of pending, 1.3. We only got up to 2. So Snohomish County did not crest and make it out of the seller's market. One thing we've been talking with all of our team about, all of our buyers about, our investors, is no, I'm saying that incorrectly. Because inventory is low like this, as the spring market comes through and the cherry blossoms come out and more buyers start looking, there is more inventory that comes onto the market. You can see that happen. But the demand also shoots through the roof, which then causes those bidding wars to happen. So expect to, all the way until June, for there to be more and more increasing competition until the market peaks. How do you know the market peaked? The market will peak when the list to sales price ratio starts to come back down. If we're talking about things that are affordable, because we're already seeing this, you're seeing bidding wars in the affordable or the lower price range. And you're seeing bidding wars at the upper end. And my belief on that is we've got a bifurcated market. And what I mean by that is, unfortunately, inflation is like the massive hidden tax against middle income and below. And so inflation is eating that bottom end. But what's also happening with inflation is what I like to call the great melt up. In other words, those with assets are seeing their assets rise during this inflationary time. So you got bidding wars at the top because they have lots of assets. You have bidding wars in the affordability or the starter home price range because there's so little supply and we're not building affordable smaller homes anymore. Why? It's not economically feasible. We don't have enough buildable land. And so the middle is the part that is actually the slowest part of the market. Kind of crazy, but you can see it directly in the data. I'm not going to get into it, but you can see it in the data. Let's go to the percent of original list price. Percent of original list price. We ended last year at 97.2. You can see in January, and then bam, all of a sudden bidding wars were in February. They continued all the way till April. Then they started cooling off, dropping into the 90s. And then we finished the year at 97. Shows depending, 15. Shows per listing, 5. I'm going to show you Pierce, just to show you it's the exact same thing. Okay. So Pierce County, exact same trend. Ended 5% month over month for December. New listings, slightly up. Pending sales, slightly up, 8.8%. Closed sales, okay, up 27%. That's really good. Right? That's probably beating most of the areas. Days on market, 45. Okay, about 2 months. Percent of original list price. See, it didn't peak as high. There's just not as quite as much demand there. Okay, let's look at Skagit. Skagit, there's just not as many homes. There's not as many home buyers, okay? There's definitely a lot of farmland. So this data is not as pretty as everyone else's data. You can see it's a lot more jagged even for the median. But because of that, you can also see it didn't have as big of a drop as you saw in Snohomish County and King County. Ooh, look at that. Something expensive sold right there. I mean, that average price shooting up in Skagit County and finishing at $671,000. Holy cow. New listings up 33%. Homes for sale month on month up 20. Let's look at the closed. Okay. Mirroring what we've seen before. Percent of original list price. See, the bidding wars didn't get as strong. And you get almost 5% off in Skagit during the winter. Let's look at Whatcom. Okay, Whatcom still not back to the peak, in almost 600 in the median. Definitely a little more flat. Let's look at the average. Also not back on the average. Ended December at basically 600,000. New listings up slightly. Homes for sale up slightly. Pending sales. So see how the whole area kind of it mirrors and matches itself. Days on market a little bit higher than the other areas, 51. Supply. So they have 3 months worth of supply. So another thing to be thinking about when you look at this is there's more supply in Whatcom County than there was in some of these other areas, which means there's going to be more selection for buyers to choose from, more selection for investors to choose from. Percent of original list price, it peaked this year, June, 98.8. And then in December, wow, 6% off of the list price. So things I think we should be paying attention to. We got to watch the unemployment. We got to watch where the market's heating up, when it's heating up, because that tells us what we need to offer. We've got to watch the economy and the stock market. Oh, you know what I forgot to share with you guys? I forgot to share the 10-year Treasury. I want to share this real quick. Okay. So the 10-year Treasury. So right here, as you can see, that was a 52-week high. And why am I bringing up the 10-year Treasury? I'm bringing up the 10-year Treasury because all real estate debt basically mirrors the 10-year Treasury. The duration of the 10-year Treasury is what kind of sets the bar for real estate debt. And it goes up and real estate debt goes up. It goes down, real estate debt goes down. What affects the 10-year treasury the most? Inflation numbers, economic data. Oh, get me off the screen. There we go. So last year, we started getting those beautiful rate cuts. We got into the, we had expectations of rate cuts, and we got down basically to like 6.11. If you want to figure out what residential debt is, you can look at the 10-year treasury price, and right now at about 2.5 or 2.6, and that's what the consumers are paying for 30-year fixed debt. That spread is usually 1.8. That spread was over 3, but as these banks start to bid against each other, as the market stabilizes, as the economy stabilizes, that spread is squishing itself out. As the 10-year trends down, the market will pick up. So here's my thesis and what I want you to be watching. The Fed started cutting rates right before the last rate cut. Boom, it shot up again. This is that negative jobs report that we had. When I say negative, the jobs report massively beat expectations. Then what happened was the CPI data. The CPI data came in a little bit cool. Like it beat expectations by 0.1 on the core. I'm talking that's how barely cool it was. And then when the Fed president said, hey, we're going to need more rate cuts, the Fed was out with their mouthpiece controlling the market. That's why, because you saw the Fed out talking. You see that we've hit a 52-week high. This is why I believe we've hit the cycle high for this rate, the cycle high in this current level of rates, and I believe it's going to trend down. Now, it's not going to drop like you want it to. It's not going to go back to 3. It's not going to go back to 4. It's not going to just fall off a cliff. That's what all of us want as investors. It's probably going to slowly trend back down. So this is the 5-year, okay? As you can see, it was unbelievably low right there in COVID. But we're really back in line with where we were in the early and the mid-2000s when I started my real estate career. If rates get back down into the 5s, or as rates get back down into the 5s, and as rates get down into the 6s, realize that is a very sustainable market. And Benji, I totally agree. The 10-year has been much more volatile than normal. It's been over-responding to economic news because the market doesn't exactly know where we're at. Are we in a soft landing? Is Trump going to give us tariffs? Is the economy growing? What about inflation? There's just too many unknowns. But what's happening is I believe this sits in channels, in areas, in bandwidths. And these channels are causing it to stabilize and then slowly head in a downward direction. Now, I may be incorrect, but I am betting my own money on these things. Last but not least, if you guys have anything, just feel free to drop it in the chat, and I'm happy to answer your questions in regards to this. But one, have a lot of fun. This market is a lot of fun because it's a little bit unknown. There's not as much inventory. 2, as the weather continues to get better, expect that bidding wars will be back again this year, and expect that you're going to see above average appreciation. If we're looking at, I'm going to do King County's number for you real quick. If you're looking at King County and the median price ended at $955,000, and we told you the 10-year run for King County was 8.03% in median sales price appreciation, and last year it was 8.5%, do you think it would be reasonable to say 8%? So let's look at that. I'm opening up my calculator. You at home can open up your cell phone and do this along with me. But if I take 955 times 0.08, that's $76,400. That means if King County appreciates 8%, which it's done for the last 10 years, the average home is going to cost $76,400 more actually by the end of the bidding wars in May, June, somewhere right in there at the end of spring. That is a huge number. Okay, let me give you King County or Snohomish counties real quick, just so we're on the same page. So Snohomish County, 9.65, and last year was 6.8. So let's just call it 6 in Snohomish County. So 780 times 0.06. That means the average home is going to cost $46,800 more in Snohomish County at the end of the spring market, aka 50 grand. You can't outsave 50 grand in our metro. So if you're thinking about buying, I would get it sooner versus later. If you have any questions about specific data, hit us up with a DM. Happy to have these conversations. If you're a buyer or investor, you can reach us at rsg.com and hit that subscribe button if you haven't already. I appreciate you hanging out with me and going through the data.